in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The first step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We in the collective West are nevertheless sending billions of dollars a week to Russia for their oil and gas. This is funding the war machine. And, you know, if we're going to be serious about this, and I think we should be, we need to shut that off.
The gentleman from Pennsylvania, Patrick Toomey there, the senator in conversation with Bloomberg. We appreciate that. A lift of the market, futures up 23. The VIX was 32 level, comes in fractionally. 31.88, oil of choice today, $100 a barrel on Brent crude. In the Keene household, long ago and far away, we understood that not everybody writing on the markets came from New York City. And down in Newport News, Virginia, in the land of Gartman, was somebody named Paul Montgomery. And you read him religiously, or at least my selected parents did. Barry Ritholtz knows that Paul Montgomery had a huge impact on how we study markets, and it's not snarky to say, Barry, that Mr. Montgomery invented how we look at hemlines and how we look at magazine covers. What would Paul Montgomery say about today's magazine covers in crisis?
So he was very much data-driven behavioral economist before such a thing even existed. And whenever there was a popular, again, before memes existed, a sort of popular trading desk myth, Paul would go back and look at the data and say, hey, is this right or wrong? You know, the data is what determines. So when he looked at magazine covers, he found they fell into two distinct groups, popular magazines and business magazines. One had great resonance for noting tops and bottoms, the other pretty random and didn't mean anything.
I look, Barry, at the study today, and it's not weekly magazines. You and I, Lisa, were buffeted by minute social media with a short time frame. How do we look for contrarian indicators given the new speed of information?
So there's a lot of hedge funds and other quants and data geeks that are scraping Twitter and trying to see if there is actionable information contained in the whole of sentiment as indicated by the quality and sentiment of various posts. And some have done it better than others. It's not quite a perfect science yet. It's a little bit of art, and it's been pretty inconsistent. But the thinking is simply, when you get a very crowded trade or a very crowded market perspective, when everybody is bullish on oil, as an example, and runs the price up to $130, and the Russian Minister of Trade comes out and says, let's see how the West likes $300 oil, with my perfect hindsight, I could tell you that was, you know, pretty much the top.
Sure.
And here we are, 25% lower a few days later. We see this happen in speculative markets and where emotions get the better of traders.
Although, Barry, just to sort of sit on the oil story for a minute, because that is just a shocking move that we've seen the round trip over the past 2 weeks. How do traders maneuver around fluctuations like that, not just in Bitcoin, not just in penny stocks, but in benchmark commodities that feed into all other prices, which seems to be the new world that we're in, at least for now?
Well, let's use lumber from last year as an example. You had everybody stuck in an apartment building with their spouse and their kids, and it was no elbow space, remote work, remote learning, remote play. People wanted a little room, and so there was a mass move to pick up some houses far beyond the available supply of single-family homes. So what happens? People start building more homes, and the demand for lumber skyrockets. But as every commodity trader knows, the cure for high prices is high prices. Well, and when lumber prices double, the mills go out and they cut down more trees. And lo and behold, now there's sufficient supply. And that seems to happen with very few exceptions. Semiconductors, which have this long ramp up period to when you're starting from scratch to actually produce chips, the cure for high prices is high prices eventually, but it's not like go cut down a tree and make some 2x4s.
Here's my objection with that. This all makes sense over a period of, say, a year, or even 6 months, or even a month, not necessarily 2 days, right? You're not going to get that kind of response in a day. You're not going to even be able to game it out in a day. And I wonder if the fluctuations and the financialization that we're seeing in commodities has changed the game and made it more difficult, more harrowing for investors to use as that hedge to inflation. What are your thoughts on that?
So keep in mind, when we look at the futures markets, when we look at commodity markets, you have two players. You have the hedgers who actually are consuming or producing or selling the commodity, and then you have the speculators. And in a fast-moving situation like a war, let's say Russia and Ukraine, the consensus and the thought process, sometimes that knee-jerk reaction is wrong or fails to consider all of the other aspects. So the spike in oil is 3% of the world's oil market is now not going to be selling into the global economy. Oh my God, there's a shortfall. And then by the next day, it's like, oh, but China's going to buy it. And, you know, this is why boycotting any company's production of any good, it finds its way into the global market. And so all of a sudden, oh, so China, instead of buying it from Australia or the Middle East, is going to buy it from Russia. There goes your spike in oil.
Barry, we got to run. We've got headlines, but I just do want to say, Barry, can you get me your bracket before Wednesday so I can copy it? That would help me out.
You got it.
Barry Ritholtz on March Madness and also these serious moments, including oil, where it is. These seems like real sanctions, Lisa. This seems like another level of sanctions by the United Kingdom.
Yeah, definitely coming out hard against Medvedev, among others, as they sanction individuals. Also, the flood of companies out of China and exiting their Chinese, their Russian operations, I should say, continue. Eli Lilly is suspending investments in new clinical trials in Russia. Just another one added to that very much growing list.
In this extraordinary march, Lisa, we have to end on the reporting of Maria Tadeo in his very circumspect. There are 3 leaders of Eastern Europe, Poland, Czech, and Slovenia over in Italy near Trieste, traveling by car to Kyiv. That's the reporting.
Into a war zone so that they can express their support.
Stunning. We'll have to see how that unfolds, whether by car or plane. We will see. Please stay with us. A very eventful Tuesday towards the Fed meeting tomorrow. This is Bloomberg.
Welcome back to another special BNP Paribas Open update. For Bloomberg TV and radio from Tennis Channel, I'm Erin Coscarelli. Monday started with a major upset. Top seed Daniil Medvedev was sent packing by Gael Monfils in straight sets. It was the Frenchman's second victory over a top-ranked player and his first since 2009. Medvedev's defeat means Novak Djokovic will now reclaim the #1 spot next week. Later, 21-time major champ Rafael Nadal kept his perfect record this year intact as he eased past Great Britain's Dan Evans. Nadal clinching his 400th career win at a Masters 1000 event, 6-3 in the second set. And don't forget Tennis Channel's extensive daily live coverage from Indian Wells all starts at 1 p.m. Eastern. I'm Erin Coscarelli.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City this morning, good morning, good morning. What a turnaround in this crude market from 130 last week to 96 this morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, back in a bear market.
We've been very, very cautious.
It's a completely new regime that we're looking at.
You've had substantial market stress.
Now we have this conflict on top of that, which is really exacerbating all the issues that were already there.
The Fed, the war, commodity prices, you name it. But that's a pretty tall list.
Geopolitical risk coming to the forefront.
There is still a lot of uncertainty.
It's going to be harder to make gains for risk assets.
Unquestionably, it's a trickier environment.
It's going to be a tough time, obviously.
We're at one of the longest corrections for the NASDAQ, I think, since the global financial crisis.
A lot of fingers being cut by trying to catch the falling knife.
It's sad for me. I don't like being bearish.
It has paid to be bearish on the NASDAQ 100. Joining us now is Morgan Stanley's Mike Wilson, Kathy Jones of Charles Schwab, and James Camp of Eagle Asset Management. Kathy, I want to come straight to you. Wow, have we done some work in this market cross-asset? I'll get to crude later. In the bond market at the front end, from the 140s last week on twos to through 180 in the last couple of days. Kathy, can we push that much further?
You know, I doubt it. I think the market's already priced in 7 rate hikes by the Fed between now and early next year, end of this year, early next year. So I think, you know, where we are at the short end is pretty much pricing in most of what the market can expect. And in fact, I think it maybe has gone a little bit too far. But in this sort of uncertain environment with the Fed meeting tomorrow or announcement tomorrow, that I'm not surprised the market's pushed it that high.
Mike Wilson, 2 questions. How well understood is the Fed story? How well priced is it now?
Yeah, I mean, look, we've pivoted our, fire to ice narrative a bit. It's always been about the Fed, moving faster due to the inflation. That's the fire part. But now it's the ice part of the story, which is the slowdown. And obviously this, Russian invasion of Ukraine only exacerbates the growth slowdown. So, I think it's playing out pretty much as we expected, except it's just happening faster now because of this event. But that's the thing I think people are still, behind the curve on. I don't think it was appreciated coming into this year, as you know, how fast the Fed was going to have to move. And I don't think it was appreciated how much the growth slowdown was going to be there. So now people are catching up and getting bearish for, I guess, the right reason, which is, obviously this event is terrible, but not really acknowledging the setup coming into it. Meaning, when you have like the risk of a recession, right? Recessions happen because the situation is already weakened, and then you have a shock that tips you over. And I think that's what the markets are going to try to price in next. That's why, trying to call the bottom here is really not a great idea.
Well, Mike, when you think about the equity market at the moment, then, is it the earnings and expectations around earnings we need to pull lower, the multiple on them, or both?
Both. I mean, that's the vice. That's the vice of fire and ice, right? It's that you have tightening financial conditions into slowing growth. And that's why we were well below the street on our forecast for this year. And as I said before, now this event just makes that even more obvious. But I still don't, like I said, I still don't think the average investor appreciates how weak the setup was prior to this event, which makes this event worse, right? That's the problem. And so, if we get, look, we're all praying for a ceasefire, and we'd love to see it for a lot of reasons. Obviously, you're going to probably get a massive rally off of that if that were to happen. We would be sellers into that because it doesn't change the setup, right? I mean, the setup is the same. And even with a ceasefire or a pause in the conflict, it doesn't, you can't put all this back into the bottle. Like the genie's out of the bottle now. So it's just, it makes it harder. The first half's going to be rough. The second half could be better depending on policy choices and how this war, kind of resolves itself. And that's going to be what we have to monitor to see, when the risk reward gets attractive. But the risk reward is not attractive at 19 times a number that's probably going to have to get cut.
Well, let's talk about that number. To what? You said in your research, and I read it yesterday, it was a great read. This line here, this likely means a collision with equity markets this spring with valuations overshooting to the downside. Can you put a number on that, Mike?
Yeah. So, I mean, as you know, John, our longstanding view has been 18 times as fair value. That's how we got to 4,400 for year end back in November. But now, of course, that 18 times, may not be, and that's fair value kind of at the end of the year, assuming things go well, right? But of course, things aren't going well, and inflation is out of control, and volatility is out of control. So the equity risk premium, I would argue, and we showed that in our note, is maybe 100 to 150 basis points too low. And if that's right, then you could easily see 16 times, even 15 times on an overshoot if that risk premium wants to go to 450, which doesn't seem like a crazy level given what the state of the world.
James, is there a reason for the Federal Reserve to back away before they've even started?
Our take is absolutely not. I mean, this inflation story that we began talking about 14 months ago started with supply chain. Then we had the massive demand pull forward because of stimulus. We have the highest inflation in 40 years. If the Federal Reserve is true to its word of price stability, they have no choice. And I think the easier choices could have been made last summer. The Fed passed on that. Powell did his pivot after his renomination back in October, November timeframe. And we're looking at a reacceleration of the inflation story because of the conflict. So to the other guest's comment, yeah, the 2 and 3 year treasury has already priced in some moves, but the Fed's going to have to be aggressive to reestablish credibility here. And let's remember, this is a political issue now. Every American has seen price inflation at the pump and food stuff. President Biden looked in the camera and said, this is the Federal Reserve's problem. It is the Federal Reserve's problem, and they're going to have to act. And we're in the camp that we think we're going to get 5 or 6 hikes in 2022.
And they're set to act tomorrow. 5s right now through 2%, 2s at 180. The Bank of America Fund Manager Survey reads as follows. Russia now the #1 tail risk. Equity allocation the lowest since 2020. Growth optimism the lowest since 2008. Katie lines some big lines in that report this morning.
Yeah, very, very bearish, John. But we have to keep in mind, we've already seen $12 trillion erased from global equities in 2022. There is a long list of global benchmarks that are in bear market territory. And the NASDAQ 100, as we know, entered that yesterday, down 21% from its peak on November 19th. That is the first time that has happened since the depth of the pandemic sell-off in March of 2020. And obviously, a lot of that move really has been driven by inflation, fears around the war in Ukraine making that worse, and the resulting tightening that could follow, meaning rates go higher and some of those higher value companies, those richer multiples, they're going to come under pressure. But this isn't just a tech story. It's really been true across equities, including the S&P 500, which, while didn't enter a bear market yesterday, did enter a technical death cross for the first time since March 2020. So basically, the 50-day moving average just crossed below that longer-term 200 DMA. Historically, though, that's more of a lagging indicator. Usually, by the time it appears, the S&P is already down by double digits, which is the case this year with it off more than 12%. And that is the worst January 1st to March 15th period, going all the way back in history, the 4th worst time. In the interesting part, though, is that in the other 7 times that has happened, 5 of those years, the equity market actually closed higher. So we have to keep that in mind. And just looking beneath the surface of the index, it hasn't been down for everything, just everything other than energy, at least on a sectoral level. That is still up 33% on a year-to-date basis, even as we've seen oil coming off 20% in just 5 days. But for the laggards in this market, all of them are those more tech-heavy sectors, tech, communication services, discretionary, all down the better part of 20%, John.
Kelly, are you happy to say that crude's in bear market territory? Would you go there this morning?
I think you could go there. Of course, it's pretty brutal this morning, John.
Kelly Lyons, thank you. Brent crude, 100. We were pushing 140 2 Sundays ago. Sunday evening, this oil market opened up stateside, and Brent crude was at 139. WTI through 130. This morning, Brent at 100, WTI at 96. Kathy, can I ask someone in the bond market, ask you, what on earth is going on in the land of commodities?
Well, I mean, this is pretty classic. When you have shortage, perceived shortage, you have to ration that short supply, and you have to do it at the front end of the futures curve, right? And so that's why we got into backwardation, because you pull forward the pricing pulls forward that supply for the near term. But once you've satisfied that, and then you get this huge reversal. And I think that what we're seeing is, we saw it actually earlier with wheat. We've seen it with some of the other agricultural commodities, and now it's fallen over into the energy market because the supply is still there. And now everybody who had to get their hands on it in the short run, and everyone who put on a speculative position because they thought there wasn't going to be any oil forever, now has to liquidate. So it's a fairly standard kind of commodity market performance in a situation like this. I've been through a lot of these. I think for the bond market, you know, the key is, well, where are we going from here, right? Where is the inflation picture going from here? It's still a pretty mixed bag, and I think that's what the Fed really has to deal with. They have rising inflation and high inflation and rising inflation expectations. Now, they're not super high, but they've broken out of the range that I think the Fed is comfortable with, and so they need to act. But at the same time, you've got tightening financial conditions, slowing economic growth. You've got this sort of unprecedented tightening in global liquidity right now, or the potential for it because of the sanctions. And so it's a real mess for them to deal with. I think they try to take a cautious approach, but talk big about fighting inflation.
A mess is the right word. Brent at 100, WTI at 96. Mike, Kathy, and James are going to be sticking with us. Let's get you some moves ahead of the opening bout. 20 minutes away. Here's Abby.
John, well, it seems that mess in crude oil and the commodity complex may be helping out stocks, because we do have the S&P 500 E-mini futures higher, along with the NASDAQ 100 E-mini futures. Those are leading the way. Perhaps the first up day in 4. Microsoft, not surprisingly, then one of the top stocks, up 1.3%. This, of course, as yields are lower, giving some relief to high valuation tech stocks. Plus, Microsoft is expanding its healthcare and cloud strategies. United Airlines, the airlines really soaring. This, of course, as oil goes lower, the cost of jet fuel. This airline and American Airlines are not hedged, so this goes directly to the bottom line. Occidental Petroleum, the E&P producer, on the other hand, you can see down sharply, down 5.6%. And then finally, that brutal bear market, that sell-off in China tech stocks, it continues. It started with Alibaba, and there you have Alibaba in the pre-market down another 4.7%.
The CSI 300 over in China, and Abby, thank you, at the close today, down by 4.6%. The Hang Seng down by almost 6 percentage points, negative 5.72% at the close. Coming up on this program, Europe looking to impose fresh sanctions on Putin.
You will have a new ban on some exportation, like the luxury goods, and we will withdraw to the Russian state the most favored nation clause within the World Trade Organization.
The latest on Russia and Ukraine next.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
The new package of sanctions that will be adopted this morning. That's the strongest package of sanctions ever adopted by the European Union in its history. We will have more than 600 Russian people being targeted by those sanctions.
The European Union preparing to deliver a fresh round of sanctions on Russia, this coming as the prime ministers of Eastern European nations travel to Kyiv to meet with Ukraine's President Zelensky. The Czech Premier writing on Facebook the following: the purpose of the visit is to confirm the unequivocal support of the entire EU for the sovereignty and independence of Ukraine. Team coverage starts right now with Bloomberg's Anne-Marie down in DC and Maria Tadeo in Brussels. Maria, just set the scene for us. European leaders heading into a war zone.
Yeah, and it's incredible, Jonathan. I mean, this is in every manual of what not to do with an active head of state. We know that the Polish prime minister, the Slovenian prime minister, and the Czech Republic prime minister are now on their way to Kyiv. A lot of the details in terms of how they got here are still very secret. We really obviously don't know, and the reason for it is security reasons. This is a Ukrainian capital which is encircled by Russian troops. Now, the goal of this meeting, of course, is to send, according to an officer from the Polish prime minister office, a very strong political message that the European Union is standing behind Ukraine. But I would note a lot of this was done by the Eastern Europeans themselves. So they're going there almost on personal capacity. And remember, Jonathan, we've talked about the different sensitivities across Europe, where you speak to the Western European countries, they do feel threatened by Russia. They do say we do not trust Vladimir Putin, and a diplomatic solution out of this is going to be very difficult. Now, on the flip side is still the German Chancellor and the French President Emmanuel Macron, who's been on the phone pretty much daily with Vladimir Putin. They still say they can get to a ceasefire and a diplomatic solution if the two sides agree on basic terms. Now, the problem, of course, is that we've seen that for the Russians and the Ukrainians, the definition of a ceasefire at times is very different.
The situation in China, I think, is fascinating, Keir. AMH, if you look at the move in Chinese equities, you can talk about regulation from last year, the hangover into this year, you can talk about lockdowns, but then you can talk about the relationship with Russia too, and what this could mean for the Chinese economy. AMH, there was a 7-hour meeting yesterday between Jake Sullivan, the National Security Advisor, and his Chinese counterpart, the top diplomat. And we have very little explanation as to what actually happened in that meeting. What's the readout? What's the read-through?
So on the Jake Sullivan side, we learned that it was a substantive conversation. And then from Beijing, they called it constructive as they met. But Jonathan, as you mentioned, 7 hours, very little details, very slim on exactly the specifics that was discussed in this meeting in Rome between the two. But obviously, this comes as the United States, which we have learned in our reporting, first reported by the Financial Times, has sent cables to the European allies saying that Russia was asking China for military drones. On top of that, you also have the United States wanting to make sure, not that they don't come to the rescue of President Putin, not just militarily, but make sure they abide by the sanctions regimes. And I think you have a very explicit comment this morning from Foreign Minister of China, Wang Yi, saying that they want to make sure that they maintain their own sovereignty, their own rights as a Chinese country, that they are not going to be impacted for these sanctions. And that raises the question, Jonathan, of what would happen to China if they were to help Russia skirt some of these sanctions.
Maria, that issue right there is massive. And on that request to the Chinese for military assistance, the Chinese denied it, one, and then the FT reported yesterday that the Chinese were open to it. To the both of you, thank you very much. This line from Mike Wilson just jumped off the screen, off the page to me yesterday. Mike, I want to go through it with you. Finally, recessions occur with the arrival of an exogenous shock when the consumer is already in a weakened state. Now, Mike, you know that's where you'll get the pushback. People will be sitting there saying, already a weaker consumer. Where's that come from, Mike?
Yeah, well, I mean, John, we have no problem embarrassing ourselves and sticking our neck out, but I mean, like, that's been our view for a while. And prior to this event, we felt like the consumer was going to have trouble in the first half of this year for some reasons that I think people have been overlooking. The first one being the government transfers, obviously ended in January in a lot of different areas. Number two, inflation now is really eating into discretionary spending. I mean, it's just, people have to spend money on gas and food and other items that are necessities, so that limits their ability to spend on discretionary items. And then we have this payback in demand where even if I have the money and I have the ability to buy stuff, who needs another durable good? I mean, like we did all that already, right? So, and then of course now with this invasion, things like travel and leisure, that may go on the back burner. So services was going to be the big offset this year. And that was our view that, consumer wallet share would go from goods to services. But that now looks questionable given the price of some of those services and also given just now more apprehension about the state of the world and the impact on consumer confidence. Now, I've published this stuff for a while, and you've seen it, John. You read our research. I mean, like, consumer confidence is already in recessionary levels. That was prior to the invasion. So yep. I don't really understand why people aren't talking about that more. They're somewhat dismissive of it because labor market's been strong, but that's just where we are. I mean, the consumer is not feeling great about the state of the world.
You saw it in the data from University of Michigan. James Camp, your reaction?
Well, I think confidence is definitely rolling over, but we have to remember the savings rates, the inertia of a lot of these government transfers is sort of still in the system, and we can sort of parse savings rates by income and wealth quartiles, and we do see that it is highly skewed towards the higher incomes. I still think there's some momentum to the consumer. I think spending expectations, retail sales, et cetera, are still reasonably good, decidedly to us not in recessionary territory. But I think we're getting into this rate of change stuff, and I think these are the conversations that we have to have. Absolute levels of inflation and prices are still high. Rate of change data inevitably is going to slow because of base effects. The question now becomes, do we have enough inertia in the economy to keep the consumer alive so we don't roll into recession? Or does the Fed necessarily, to kill the inflation menace, have to kind of push us there? There are no good choices here. That's the key. The Fed has no good choices, in our opinion. But I think job one is going to be price stability and inflation. And I think inevitably that's going to push us closer to a slowdown or at least a quarter or two of negative growth. Our expectation is companies still earn well, margins still expand a little bit, pricing power is back in a lot of the company areas. And again, to Mike's point, there's going to be an interesting juxtaposition against consumption of goods, which was supply chain constrained, and if our mobility data starts to pick up, if experiential consumption services, to Mike's point, starts to pick up. We expected that it would. Again, the wild card in that is the global and geopolitical events that may get people to retrench. But we still think the consumer's pretty robust in 2022.
Kathy Jones, on this topic, final word.
Yeah, I would agree that the consumer is still in decent shape, but we have expected a deceleration in spending, obviously because you have the fiscal stimulus wearing off, and we've exhausted, or at least probably exhausted, a lot of the demand on the goods side. So services should pick up the slack. I think the telling statistic for me recently was the revolving credit number that we got last month. So we've been seeing pretty good spending and an increase in consumers using their credit cards, and it started to roll over last month. Now that may be because the fiscal stimulus is wearing off. We also are seeing mortgage rates move up that might slow the housing sector and slow the refis, which is where people cash out to get more money to spend. So we do think in the second half consumer slows down, but we're not yet in recessionary territory in terms of consumer incomes or spending.
Kathy Jones, Mike Wilson, James Camp sticking with us into the opening bell. Coming up, the morning calls and later, traders pricing in 7 hikes for 2022 ahead of decision day. More on the Fed's path forward. Still ahead from New York City with futures up 0.6 on the S&P and the Nasdaq bouncing back. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
The Nasdaq 100 at the close yesterday in a bear market. A bounce back this morning on the S&P, the Nasdaq and on the Russell too. In the equity market, that's the story. In the commodity market, what a move lower from where we were just a week ago on Brent and WTI. Brent right now, just north of 100. WTI with a 96 handle. That's the price action. Here are the morning calls. First up, Benchmark upgrading Zoom to a buy, a 124 price target, praising management and the company's potential to realize ambitions. Next up, Goldman downgrading Hormel Foods to a sell, a 44 price target, seeing disruption in food and supply chains from the war in Ukraine. And finally, Jefferies lowering its price target for GM to 44 from 53, noting a stagflationary environment of higher input costs. We're flat there in early trading. Up next, traders turning hawkish as the Fed kicks off its two-day policy meeting, looking for 5, 6, maybe even 7 interest rate hikes this year.
When you think space, you probably think one space agency that travels under the radar is ESA. which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I'm not going to do that thing where I give you a nice little neat narrative to explain the price action of the day, because in about 5 minutes it could all change. Futures up 0.7%. That's where we are right now on the S&P 500. On the Nasdaq, we're positive 0.9%, a bounce after closing in a bear market yesterday on the Nasdaq 100. There's the opening bounce. Switch up the board and get to the commodity market. The crude market, which loves to make a fool out of pretty much everybody who tries to forecast it. 95.94 on WTI, through 130 about a week ago. On Brent, sub 100 earlier this morning, approaching 140 a couple of Sundays back. In the bond market, your 10-year yield now coming back down by 5 basis points on the day to 2.08%. A week ago, trading in the 160s. Twos, the 140s last week, and now in and around 180. Euro dollar 109.84, positive on that currency pair, 0.4%, just short of 110. At the opening bow, we advance about 0.8%. Top of the pile, utilities, real estate, information technology at the bottom. As you might expect, given where energy's trading this morning, crude lower, energy stocks lower by 1.3%. With your movers, here's Abby.
John, well, with this bullish start for stocks, let's start out with what is working, and that is most sectors, as you were just talking about. But relative to individual movers, technology, very strong. NVIDIA, the chip overweight stock, is sharply higher, up 1.4%, as yields are lower, and really just a bounce back. That extends to Tesla. They obviously have the EV part of the company that maybe does not fare as well from a psychological standpoint when oil is down, but the technology side doing just fine, up 2%. Delta Airlines soaring, up 9%. This, of course, as oil is in, as you were talking about, that translates right to the bottom line with not a lot of hedging there, plus jet fuel in. They're also at a JP Morgan conference, as are some of the other airline executives, talking about the fact that profitability is likely this year. Speaking of JP Morgan, yields are down, but the banks are extending the rally to a second day, John.
Abby, thank you very much. Tomorrow, the main event, the Federal Reserve. Your two-day meeting has already started. Here's Mike McKee with more. Morning, Mike.
Morning, John. Well, you just mentioned that commodities are making fools out of anybody who tries to forecast it. Imagine the Fed. The entire economy depends on you. You got to forecast what's going to happen with commodities, particularly oil. Now, we know what's going to happen tomorrow. We're going to get a 25 basis point increase in the Fed funds rate. But they also have to update their economic forecasts and the dot plot. They're going to have to raise their forecast for inflation. The question is, how much? Then Jay Powell comes out and explains it all. Does he sound hawkish or not? Now, here's the big move of the day tomorrow, and that's the dot plot. You can see there the blue line is where the market thought rates would be on December 15th, the last time they put out the dot plot and the forecast. The line on the top, the white line there, is where the market thinks now those interest rates should be. How close does the Fed come to the market's belief? That's going to have a major impact on how people trade after 2 p.m. tomorrow. And there are a lot of questions for the Fed going forward. Risks, Russia war, obviously, and we don't know what's happening with oil because of that. COVID, signs it's coming back. And maybe there's some other surprise out there. Inflation, base effects coming into play here coming up in the next couple of months should push inflation down. If oil continues to fall, that should push inflation down. We'll have to watch that. And then, of course, the balance sheet reduction. When and how do they start cutting back on the balance sheet? A lot of questions for the Fed and a lot of things that are very hard to answer at this point.
They've got to deliver the forecast, Mike, whether they like it or not. Looking forward to your coverage tomorrow. Mike McKee there. The S&P 500 up 1%, 3 minutes into the session. The NASDAQ Composite up a little more than 1% as well. Jim Bianco of Bianco Research shot me a quick message just yesterday and said, remember the exchange with Chairman Powell and the Republican Senator Richard Shelby at a hearing just a number of weeks ago. Don't forget that, and let's take a listen again.
Is the leadership at the Fed under you and the Fed prepared to do what it takes to get inflation under control and protects price stability?
I hope history will record that the answer to your question is yes.
Kathy Jones, does Chairman Volcker turn up tomorrow?
Well, I think that is probably what's planned for tomorrow. But again, Powell has to really thread this needle. So he has to talk about how they're going to be tough on inflation. They're willing to do whatever it takes. And that certainly, that exchange stood out to me as well. On the other hand, you already have credit spreads starting to widen. Now we've got commodity prices having reversed. You've got the Ukraine war, which hadn't been anticipated, and you've got a very flat yield curve. So here we are, the 2s10s is down to under 30 basis points. That spread is very low. So how much can the Fed deliver in terms of, oh, we're willing to fight inflation with a bunch of rate hikes without just inverting the curve? So I think they're in a very tricky position. I'm hoping to hear something more on the balance sheet, although I think they'll probably punt that to the next meeting or the meeting after that.
James Camp, your expectations?
A tricky position to be sure of their own making, I would suggest. I think the key is going to be what the long end does in terms of reaction function. We have a war in Ukraine right now, and we only got down to 160 in the flight to quality trade, and we've already reversed that. I think the marginal buyer, the price indiscriminate buyer of treasuries, the Federal Reserve, exiting the market. I think the fact that we have essentially told Russia that their reserves are worthless is going to put some pressure on not only the dollar, but on the buyer of treasuries. And I think the Federal Reserve has to raise rates, one, to protect the dollar as reserve currency, and the second is to really be serious about the inflation outlook. So to me, the Fed has no good choices, again, of its own making. This is a political conversation. Make no mistake, Senator Shelby, President Biden, this is the Democrats in the White House have approval ratings that are struggling mightily because of this regressive tax. And so I think the long end goes higher. I think inflation pushes the long end higher. I think the marginal buyer is exiting, and I think the yield curve can steepen from here. And Kathy's quite right. It's too flat to tighten 4 or 5 times, but I don't think the current configuration stays. I think treasuries move higher from here.
James, if you think 10-year and 30-year yields go higher, aren't you essentially saying this Fed can engineer a soft landing? And how narrow is that runway? I'm trying to understand the range of probabilities around these outcomes. If your base case is higher yields, doesn't that mean you believe the Fed executes that soft landing?
Well, no, I think the Federal Reserve tightens credit conditions that are already, as noted, tightening. Spreads are widening. I think we get credit conditions into the tightening area, and that orchestrates a slowdown. I do think as rates push higher, at least technically, over the near term, that is going to be a very good buying opportunity for income investors. Probably the best that they've had in a number of years. If we get to a 2.25, 2.5, and the back end of 2022 does look like a slowdown to us, perhaps not recession. But again, this is a tactical trade. We're seeing pressure on the long end. We're going to continue to see pressure on the long end. That does not mean we simply think we'll stay there and continue to go higher. Inflation is higher than 2%. In any scenario, it's going to be higher than 2%. So I just think that this is going to be a story of rising yields for the first half of the year, Fed front-loading the moves because of the political season, and the inflation data not getting better in large measure because of at the margin, the Ukraine incursion.
Mike Wilson, you're not waiting half a year. You're already there. In this note, we think long-dated bonds could offer a decent hedge for equity portfolios, which are now more at risk due to a growth slowdown. Why is that, Mike?
Well, I mean, it's for the reasons you kind of set up this question, which is I totally agree with your, talking about Senator Shelby's, questioning of Chair Powell and his response to that. I think it's quite clear that this chair is going to go the distance, okay? Meaning they're going to fight inflation, and that's going to require, probably breaking the back on growth. So whether that's a recession or not, I really don't care. But I do think that particularly the back end, 20-year and 30-year tenor, now is starting to look relatively attractive if you're running a portfolio of stocks and bonds. And here's why. Our concern now is growth, okay? Our concern is not about the Fed. The Fed is overpriced at this point. It's just like it was underpriced 6 months ago. Now it's like a race to see who can have the most rate hikes in. It's kind of comical in that regard. But, so we're priced, okay? We're priced for 8 hikes over the next year. If they get that done, congratulations. And I agree with the statement, I wrote it this week, the same thing. If they get 8 hikes done and back end rates move out, that means they were successful in engineering the soft landing. I don't think it's going to be that smooth. That doesn't mean recession. It just means that growth expectations are going to come down. And so if you're worried about growth like I am, then the back end of the yield curve is offering you very cheap protection, like it usually does historically, okay? Because remember, in this sell-off of stocks, and by the way, we've been in a bear market for stocks now for 4 months, not a week. And that's been happening as rates have gone up, meaning bonds have not provided the shelter they typically provide, which means now they're actually probably a pretty good buy for that protection against a further growth slowdown. If you're not worried about growth, then you shouldn't be buying treasuries at the back end, okay? You should be buying stocks. But that's not our view. Our view is that we think growth is going to disappoint.
Mike, lift the lid on the index then. We've done a ton of work to punish tech names, big tech names. On the S&P, I believe year-end you're at 4,400. Let's get away from the index stuff just for a moment. Go into it sector by sector. And on the consumer, which I have to say, your outlier call, as I go through your research with the team, has to be this consumer weakness. Where are you looking in the equity market that hasn't been punished that you think needs to be punished?
Yeah, well, we do still think that there's more risk on the downside for the consumer, particularly on the good side, but maybe even services too, we'll see, but definitely on the good side. We think technology is still overvalued in many pockets. But more importantly, John, we think that technology is inherently cyclical. Okay, this is the thing that I think a lot of investors don't agree with us on, which is that technology has a secular sort of bullish trend to it, but it's still inherently cyclical around that. And of course, pandemic did not allow that cyclical reset because there was a pull forward in demand. So I think there's a chance we have actually a recession, a mild recession in technology spending this year as a payback in demand. That needs to get priced. And that has not been priced yet. Industrial is also another area where you're seeing incredible supply chain challenges. And of course, now with this invasion, it's going to make those worse. So those would be 3 areas, I think, where there's still probably significant downside, if the growth, kind of scare narrative plays out. If that doesn't play out and we're wrong about that, well, then you don't have to worry about it.
So, Mike, you put out a range of forecasts. Most banks do. There's a bear case, there's a base case, there's a bull case. Can you walk me through where you're leaning towards? What kind of scenario? You've gone through that, you've painted a picture. Now give me the numbers at the index level.
Sure. Yeah, I mean, we've written about this, and we are more skewed towards the bear case, and we were already the most bearish in our base case. Our base case was 4,400, bear case was 3,900. Remember, that's a year-end target, okay? So we always expected to overshoot on the downside relative to our base. We were talking about 4,000, John, back in January. That's probably a place we would go to, and then we would have upside to the 4,400. But now 4,000 doesn't look that attractive if the year-end, price target is 39. We haven't officially moved to that yet, but we're leaning in that direction. So I would say where we would get interested now at the index level, okay, would be somewhere between 35 and 3,800 to give us the appropriate amount of upside, given the risk that we're still assuming.
Mike Wilson, a clinic on the equity market, on the bond market. Kathy Jones and James Camp, to the 3 of you, thank you very much. A day away from a Federal Reserve decision. Coming up, the US seeking to prevent China from coming to Russia's aid.
We have communicated very clearly to Beijing that we won't stand by if we will not allow any country to compensate Russia for its losses.
The Chinese government has some problems abroad and at home. We'll talk lockdowns next.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The National Security Advisor and our delegation raised directly and very clearly our concerns about the PRC's support to Russia in the wake of the invasion and the implications that any such support would have for the PRC's relationship not only with us, but for its relationships around the world.
Chinese assets, risk markets, equity markets are getting absolutely hammered at the moment, and there are 3 reasons for it. One's that, the relationship between Russia and China. The other is the regulatory hangover from last year, and now we're talking about lockdowns too. The team at China Renaissance Security is saying the following: the sell-off is overdone, but so is everything else. The market is crazy. There's no fundamentals anymore. This is what it sounds like, Damien Sasser, when you're on the wrong side of the trade. This might be worse than the 2008 financial crisis. I should not joke, but you know where I'm going with this. Damien, what's going on?
Yeah, you know, I mean, Jonathan, these moves in China, I mean, you almost have to look at it and think that the impact, the market impact, is actually worse than that of the crisis in Ukraine, right? I mean, look, let's just be clear. Tencent, Alibaba, and Meituan, 3 of the largest constituents within the Golden Dragon ADR index, within the Hong Kong China index, all are down roughly 75%. I'm talking in dollar terms. I'm talking in market cap. 75% of the market cap destroyed since February of 2021, Jonathan. It's quite unprecedented, even in China standards.
I wanted to talk about lockdowns with you, and then this headline just dropped from Dow Jones, the Wall Street Journal. Saudi is weighing using the yuan instead of the dollar for China oil sales. And take a look at what happened to dollar CNH intraday. Just look at this rollover following this headline.
Yeah.
Damien, walk me through what you think as I read that out. The Saudis are weighing using the yuan instead of using the dollar for China crude sales. That from Dow Jones.
That's amazing. I mean, look, you know, the reality is this dollar yuan, and I was going to talk about it going in the other direction, because for the past 3 days, I mean, we've lost, well, I mean, roughly 1.1% in dollar yuan for a currency cross that's supposed to be managed by the PBOC, ultra stable. For it to go down 1.1% in that short a period of time is nothing short of spectacular. It's now down 40 bips on the year. Jonathan, as we know, the yuan, and many people have been talking about the China yuan as being the safe haven currency amidst the crisis, and it sure looked like it. But now with these equity market losses, I mean, all bets are off. And now, you're right, a little bit of support here on the back of the Saudi news.
Yeah.
But even that is kind of difficult to believe in the current environment. You know, my base case is the fact that China's going to want to toe the middle of the line here. They're going to want to do everything they can not to disrupt the relationship with Russia and the U.S. It's interesting to see how this will be perceived in Beijing.
Damien, stay there. Let's sit on this breaking news. We've got the perfect guest with us from London, Bloomberg's Javier Blas. Javier, we were going to talk about something different again, but let's just go right here. What do you make of that headline, Javier? Saudi be, according to Dow Jones, weighing using the yuan instead of the dollar for China crude sales?
Well, it will be really unprecedented for Saudi Arabia to sell their oil in any currency other than the US dollar. They have been doing that since the 70s without interruption. So it's quite surprising, but we have seen news that Saudi Arabia wants the Chinese leadership to pay visit to the country. Saudi Arabia is also trying to sell another stake in Saudi Aramco. Potentially Chinese buyers could be interested. So it seems like a big pivot of the Saudi leadership towards China and moving against or away, at least, from the United States.
Javier, that divide between this administration and Saudi Arabia, do you think this line, this reporting, the sourcing for it has something to do with this? Are they speaking to China at the moment, or are they speaking to the administration, the White House?
I think that they are speaking to both. I think that they are certainly speaking to China, and the relationship between Saudi Arabia and China has improved significantly over the last few years. But I also think that they are sending a message to the Biden administration. If you don't like us, we don't need you. So make your mind. I think that Mohammed bin Salman sent that same message on the interview with the Atlantic magazine, saying that he didn't care anymore what President Biden thought about himself or the kingdom. And so, yeah, this is a message as much to Beijing as is to the White House. Saudi Arabia is saying we have other friends.
Javier, Brent's gone from close to 140 to 99. WTI has gone from around 130 to 95 in a week. Could you explain to me what's going on the screen this morning?
Well, it's difficult to explain when you look at the physical market and you see how tight the physical market is. But two very bearish factors right now. One is the lockdowns in China that we were discussing, and then the potential good news on a potential nuclear deal between the United States, Russia, and other countries and Iran. So that could bring more extra supply from Iran and also reduce the demand from China. But one thing that we are seeing is virtually everyone in the oil market is taking a step back and stop trading. If you look at the open interest, the amount of outstanding contracts is at a 6.5-year low. If you look at the bid-ask spread, has widened and at times is at 6-7 cents of a dollar. I mean, this is the world's most liquid oil contracts, WTI and Brent. It will trade on a bid-ask spread of 1 or 2 cents, no more than that. We are seeing at times this morning the bid-ask spread as wide as 7 cents. That is unusual, and it really is an indication of the very little liquidity that there is out there in the market.
And Damien, that's the commodity market. I wanted to finish on one final question with you as we shift forward to tomorrow in 30 seconds, because you and I will have this conversation tomorrow anyway. Yeah. Those two interest payments on those two Russian bonds, you think they're going to be missed?
Well, I mean, look, yes, I do. I absolutely do. But, we're not going to know about it tomorrow, and we may not even know about it the next day or the day after that. But I do believe that there is a willingness on the part of the U.S. not to accept that payment. More importantly, Russia is kind of reluctant to make the payment, right? So I don't believe they're going to be, look, and even if they don't default tomorrow, heaven forbid they find a way to deliver dollars offshore to creditors, and this all we're seeing with Clearstream and Euroclear and all the piping and the plumbing that goes hand in hand with making those payments. Even if they try and make their best effort, I'm still not convinced that it's not going to lead to a default further down the road. Remember, value at risk shocks occur in both directions, and they occur in stages, Jonathan. They begin with price, they then go to vol, and then they go to the real economy. I think the economy is starting to look through the inflationary shock, looking to the growth slowdown at the end of the year, and I think that's where we lie.
Damien, fantastic as always, buddy. Gents, thank you. Damien Sasser, Javier Blas on this crude market, China, and everything else, including Russia tomorrow. Let's get you some sector price action. We can do that with Kriti Gupta. Morning, Kriti.
Yeah, good morning, John. You are seeing a fairly broad rally in the market. Consumer discretionary is your leader. Your one sector in the red is going to be energy, of course, following those energy prices lower you were just discussing with Javier Blas. Let's round out that conversation, though, and talk about what it means for the airline stocks, because that's where you're seeing really a lot of action. Your biggest airlines, United, Delta. This, of course, comes off of news that Delta sees its first quarter revenue about 78% recovered versus 2019 levels. That's relative to the 72 to 76% range that you are seeing earlier. And last of all, remember, a lot of these companies aren't hedged against oil prices. When you see oil tank, that's good for the airlines.
Kriti Gupta, thank you. Coming up, the market-moving events in your trading diary. That's next from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Let's call it 26 minutes into the session. We advanced by 0.6% on the S&P. On the Nasdaq, bouncing back by 0.75%, closing on the Nasdaq 100 in a bear market yesterday. The winner of the year, the loser of the session, energy equities. Why? Well, here's the why. Crude, Brent, down 6%. WTI, down 7 from 130 and back down to 95, just like that. Very quickly. That's the price action. Here's the trading diary at the top of the hour. NATO chief Jens Stoltenberg holding a news conference. European officials meeting to discuss Russia, 10:30 Eastern. Russia's coupon payments on $2 bonds coming tomorrow. We will hear from the president of Ukraine addressing Congress as well. And a big week for central banks with the Federal Reserve kicking things off. From New York City, this was the countdown to the open. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work.